Hi, good morning everyone in the US and good afternoon to people in Europe. My name is Gad Lebanon and I'm Chief Economist North America here at the Conference Board. And welcome to our July edition of Economics Watch. We have an interesting program for you today with an update of our global outlook. So we have some new numbers for you for the world. That would be the main feature, plus we'll have regular updates on the US, Europe, and emerging markets. I'll tell you in a minute who's going to be with us today, but just a quick look at what we're going to talk about. So China is featuring heavily in this webcast. It's losing momentum, so we're going to talk a little about that and the role of the trade tensions, and that together with the Brexit uncertainty, what impact it has on the euro area. And finally, we'll also talk about the US, and US is slowing down as well, partly as a result of the labor market tightening. So those are the main things that we're going to talk about. And now some webcast tips. Of course, please ask us a question as they come along. Don't wait until the end. And if you're interested in CPE credits, you can type your full name. You have to click OK 3 times during the program, and you have it's only available, the CPE credit, for live webcast only. So together with me, three colleagues. Here first, in the Brussels office, we have two senior economists, Ilaria Masali. Welcome, Ilaria.
Hello, Gad. Hello, everybody.
And also Abdul Arumban, also senior economist in the Brussels office. Good afternoon, Abdul.
Good morning, Gad, and good morning, everybody.
And finally, here to the right of me in the New York studio, Eric Lam, senior economist.
Good morning.
Good morning. Great. So we'll start with the global outlook. But before we tell you what we think, we want to see what you think. So we have an audience poll question. The question is, what is your expectation for 2020 global growth rate over 2019? Is it up, stable, down? What's your impression? Again, the expectation for 2020 global growth rate versus 2019. I still see that you're thinking about the different options, so I'll give you a few more seconds. 5, 4, 3, 2, 1. Let's close the poll. Thank you. So we have more negative than positive results, although the majority are expecting, the expectations are the same for 2020 versus 2019, though there are many more who expect lower, that have lower expectation than have a higher expectation. So I think that is in line more or less with the message that we will provide today. Any thoughts from our panel, some initial reactions to that?
I'd just say I concur with you. It's about consistent with what we've projected for the coming year. No crash, no recession necessarily, but a more gradual, slower growth.
Yeah. Great. So let's get to the material. So we are expecting some slowdown in the global economy, as you'll see soon the exact numbers, but it is a modest slowdown, certainly far from recession in the large majority of countries, partly because the consumer is still holding on, which we can't really say about the manufacturing sector and businesses, where they are more negative. Partly because some policy risks, the Brexit, which probably more than any time before, the threat of Brexit or a hard Brexit is looming, with a potential contraction in the United Kingdom and impact on the rest of Europe, plus the trade conflicts, US-China, but there are other headlines of other potential trade conflicts between US and Europe. So all of this is not helping confidence and reducing business confidence. As a result of the kind of slowing signs, monetary policy is becoming more supportive. In the US, it's almost guaranteed that we'll have a rate cut in July, in just a few days. So, and the expectations completely reversed themselves versus earlier in the year. In other economies, that seems to be the situation as well. So more supportive monetary environment. In the longer term, we will have the main challenge in growing faster is the labor force challenge. Working age population is very slow or even declining in a lot of countries, and that will become a labor constraint in many countries. We need some productivity growth to make up for it. We are potentially seeing some signs of that, but we don't want to celebrate yet, and they're probably not going to be large enough anyhow to completely offset the weakness in demographics. So with that, Abdul, let me turn to you about what are the update of our global outlook numbers. What are the key messages there?
Yeah, thank you, Gad. Actually, if you look at the global economy's performance in the first half of 2019, we have seen quite a bit of weakness across the board and in most of the countries globally and most of the regions actually. And we do not see much reason for the growth to pick up further in the rest of the year. So in general, what we expect is that in 2019, the growth slowdown, which has been continuing, will continue. And we see a slower growth rate in 2019 compared to 2018 globally. And this chart basically shows you our up-to-date numbers, which we have just released. Where we have the projections of major countries and regions' economic growth for 2019 compared to 2018. And you see that almost everywhere in all the countries, you see a declining trend in the global growth. This has been due to a number of factors, including the dynamics in the global trade and dynamics, uncertainties about global trade, but also in several emerging market economies, policy uncertainty in Latin American economies, dynamics, some of the challenges which Ilaria will talk about later about European economies. A number of factors are playing a role here. So all in all, what we are expecting is that a slowdown in the global growth from 3.1% to 2.6% in 2019, which is driven by a decline in emerging market to 1.9%, sorry, mature markets to 1.9%, and in emerging markets to a rapid decline from nearly 4% to 3.1%. And this decline in emerging market is driven by large markets like India and China, but also major declines in Latin American economies like Brazil and Mexico. So this is the overall picture what we are expecting for 2019.
Right, and so it seems if we also look forward to 2020. It seems like the main message is that we are likely to be in a temporary weaker growth in 2019, and we will see stronger growth closer to trend in 2020.
Yeah, that is true. If you move to the next slide.
Oh, yeah, here, this one.
Yeah. So we have some expectations about 2020, which is the first time we are releasing this year now. So where we see a bit of strengthening in the global economy. It's not a extremely high improvement in the global growth, but we expect some strengthening, but it is still below the 2018 growth rates. So we expect 2.8% growth rate in 2020 in the global economy, and that is also coming from some strengthening in some of the emerging market economies like India, but also some of the other mature markets in the group. So there are some potential for also some of the Latin American economies which have been suffering significantly in 2019. So these countries will see some rebound in growth rate, and which eventually will turn to their long-term trend in most of these countries. So I think overall the story is somewhat inconsistent with what we have seen in the poll, that it's not an exceptionally strong growth, but still we see an improvement over 2019 when it comes to next year's growth projection.
Right, so the weakness in 2019 and the recovery in 2020 are mostly an emerging market story, but in mature, we're actually seeing, we're expecting growth to continue to slow in most mature economies. Yeah.
Exactly.
Okay. And we also, I don't know, maybe some of our audience is not aware that we have a relatively new global consumer confidence measure that is across many countries. So, Abdul, can you say a little about the survey and what are some of the second quarter results that just came out last week? Tell us. Or
can I interject just for a second? We just had a question that I wanted to quickly address.
Oh, okay.
One of the viewers asked about the Chinese growth numbers.
Yeah.
They noted that they're quite a bit lower than what they had expected. Just to be clear, the Conference Board actually produces its own set of Chinese growth statistics. We don't rely on the numbers that are released by the Chinese National Bureau of Statistics. So the general trend that we've set out both historically and over the next few years is more gradual slowing. If you are thinking about the official numbers of about 6.5% or so, and then pair them with the numbers that we're reporting here, it looks like a sharp slowdown. But that is not the thesis that we're putting forward. We expect to see gradual slowdown as opposed to a sharp slowdown. So we're talking about basically two different data sets.
And the follow-up question was, so that there is a gap between our numbers and the official Chinese statistics, and there's the follow-up question is, do you expect such a reading to be recognized in the official statistic published by the authorities?
The authorities, I think, have already been managing down expectations for growth in 2019. The GDP target for this year is, I think, 6 to 6.5%. Which is lower than I think it was 6.7% officially last year. So there is an attempt to manage expectations to the downside. But with respect to the NBS actually switching methodologies and adopting something like what the Conference Board does, no, I don't expect them to suddenly start reporting 4% growth. It'll be down from what it was last year, which is consistent with our estimates, however.
Yeah. So.
I think that in terms of the trend, we will see a decline in the official growth rate also. But I think in terms of the absolute number of growth rate, we will still remain low because our estimates are built up from the bottom and are taking into account a number of other indicators and detailed data.
So that the bottom line is that if you want alternative, more accurate, possibly, measures of the Chinese economy, you should continue to come to the conference. So getting back to the global consumer confidence. So Abdul, if you can say a few words about the survey and about the results for the second quarter that were just released last week.
Yeah, so this is also very important actually because much of the growth, especially in the emerging markets recently and also mature economies, has been driven by a lot of it is being driven by consumers. Consumers have been very important actually. So recently, Conference Board has taken over the Global Consumer Confidence Survey, which has been conducted by Nielsen for a long time, since 2005 onwards. This survey is conducted in 64 markets, including a large number of emerging markets and European economies, and also some of major emerging market economies. So with a wider coverage, I think it is one of the largest, perhaps the largest consumer confidence survey globally. And what we do is that we basically, every quarter we survey 500 online consumers in every country, and on a number of questions regarding their consumption behavior and their decisions and their expectations for the next 6 months regarding a number of factors. And we take 3 major questions relating to their job prospects for the next 6 months, their personal financial situation and its impression for the next 6 months, and their current spending plans, whether they think that the current time is a good time to spend their money on goods and services. And these 3 major questions are aggregated using population and demographic weights into a kind of index which spans from 0 to 200, with 100 being an optimum level of confidence. So that basically means that any index which is below 100 is considered to be a pessimistic level of consumer confidence, and above 100 is considered to be an optimistic level of confidence. So we have officially launched this in the second quarter of first quarter of 2019, and now we have the second quarter results. And basically what the current quarter results shows is that consumers globally remain solid, showing historically high level of confidence. And confidence have improved marginally over the last quarter by 1 point, but it is at the peak point at the moment. And the most important thing is that consumer confidence improved or held steady across all the major regions of the global economy except Latin America. Latin America is one exception. I will come to that in a minute. And in this chart, where basically you have a kind of golden heat map where you see the golden colors are countries which have the very extremely high level of confidence, and the blue ones are low level of confidence. And you can see that consumers in Asia Pacific and North America are the most confident globally, and especially in emerging Asian market, consumers are extremely confident, and they are confident about job prospects, spending intentions, and their personal financial situation and everything. And European consumers
can I just ask you, since you're in Asia, I see that India here has the highest number, and there is a question from the audience about India, so I thought it would be a good time to bring it up. The question is the current water crisis in India having an effect on their economic outlook, or is it more of a temporary event without macro impact? What are your thoughts about that?
The current water crisis. Yeah, so it is not figured in our outlook or in the consumer confidence survey. This consumer confidence survey was conducted in May this year. So the water crisis, I mean, it has been accumulating, but it became very significant very lately. So that is not reflected here. Actually, consumer confidence in India has increased substantially in our results, and it also remained extremely high actually. And I think partially that was a reflection of expectations about the significant populistic spending plans announced by the government just before the election, and the fiscal easing which was expected, and so those factors was figured out, and also the inflation was under control in India. So all these factors were figuring out, but the water crisis neither in our outlook or nor in this index is being
but what impact do you think it would have, the water crisis? Is it?
I think it will have an impact, especially on the agricultural sector, GDP in India. But I don't think it will have a substantial impact on the aggregate GDP numbers for India for 2019 overall GDP numbers, which is already expected to be slowing down primarily because we have already seen significant drop in the GDP growth in the first quarter of 2019, and unemployment has reached at the highest, in historically highest level in India now. So there are already a lot of concerns going on, but government has also announced a substantial number of plans in the current latest budget to stimulate investment. So all those effects may come only by the end of the year, but I think overall the net impact of the water crisis per se is not going to be substantial to have a significant drop on GDP growth in India.
Thanks, Abdul. And in this slide we have kind of similar map, but here we're focusing on the change in consumer confidence rather than the level, right?
Yeah, so here in this chart, basically the green ones are countries where we have consumer confidence index improved from last quarter in the current quarter. And unlike the previous picture, what you see is that the improvement in the consumer confidence, even though it was visible in all the regions, if you look at across countries, it is not across the board actually. In the current quarter, only 28 of the 64 countries had an increase, while in the last quarter we had 33 countries increasing. So that means basically the number of countries where the confidence level have increased actually declined. But at the same time, I also have to acknowledge the fact that if you look at historically, the dispersion in consumer confidence index has declined, and the average consumer confidence levels have increased. So basically, which suggests that even though the number of countries per se have not increased in terms of improvement in consumer confidence, the differences across countries, the divergence of countries from the mean confidence levels, which is increasing, has declined. So basically it suggests that the trend is, in general, consumer confidence trend is that it is improving globally. And as I said earlier, only Latin America is the region now which has, as a whole, which has seen a substantial decline in the consumer confidence, but at the same time that is primarily driven by Brazil and Mexico, and Brazil has a significant unemployment crisis at the moment. It is increasing, unemployment is increasing, and both countries also have the significant setback from uncertainties about global trade, and particularly Brazil also suffered from substantial uncertainty in the policy sphere even after getting a new government. But at the same time, what you also see is that some of the troubled economies in the global economy, like Turkey, Venezuela, Argentina, these countries are showing some sort of optimism, some rays of optimism is coming to these countries. So there is a lot of dynamics going on here in different countries. But so the overall picture, what the conclusion that comes out of looking into the details of some of the detailed question also about the spending plans of consumers and so on, what basically comes out is that the rising uncertainties in terms of global trade and also geopolitical imbalances is concerning to consumers, and even though they still show some optimism about their jobs and so on, they are very likely to see a more volatile spending pattern, and they will be more likely to be more vigilant on their spending in the next 2 quarters. So this is, even though this is not giving you a negative picture about consumer businesses in these countries, it really shows that consumer business in these countries has to be vigilant, and we should be looking into how these dynamics are playing out and how further developments are going to happen in the geopolitical and trade spheres.
Thank you, Abdul. So we will get an update of those numbers every quarter, so a new tool for us to share more insights with our members. So, Ilaria, another tool that we have in our disposal is the leading economic indices, the global and for different countries. So what's the message from that tool?
So Gad, I'm happy to come back to one of our oldest and funniest toys. I have to say, I love this chart because every time I get the question, so is the recession coming this year or next year, I have something to put on. So what this slide is saying is that we don't expect a recession, a global recession, in the next 6 months. So this is our global leading economic index, which is a sort of synthesis indicator of our national leading economic indicators. And so this is a summary for the main world economies. And what you can see here is that the economy, the global economy, is in a slowdown quadrant. So there are 4 phases in the business cycle, and we come back from the phase of expansion. So if you remember the charts, a year ago it was in north of what it is now. All the most world economies were all in expansion phase towards the end of 2017, and the first half of 2018, and then it started to go down a little bit. So this is where we are now. We are in slowdown mode, but as you can see, at the world level, we're still far away from the contraction. From the left-hand panel. So this means that basically in the next 6 months, as I said, we don't expect a recession, even though we have to acknowledge that a slowdown is there for most of the world economies. So I'll prove that with the next slide, with the flags. You can see there what I was saying. There is a large concentration of flags in the slowdown quadrant again. And what is interesting is actually the UK, because it's literally the only country where the risk of a recession is very, very high, and we think this is actually already happening between Q2 and Q3. So I'm sure that when Q2 numbers come out, they will be with a negative sign. And this is something we've been saying already for the past 9 months. When we started in September last year, we started saying, okay, down the road in 6 months or so, we expect a recession. It took slightly 3-4 months longer than what we predicted initially, but our guess was actually quite correct, I have to say, on this.
Thank you very much, Ilaria, and we'll hear more from you about Europe a little later. We now want to turn to the US, but again, before you hear from us, we want to hear from you. So, the question is actually still about the global growth. So, where do you think the major threats to global growth for the next 12 months will come from? There are a lot of options here. Trade disputes, wage inflation, oil prices, profit erosion, recession in the US, Brexit, other geopolitical risks. So again, where do you think major threats to global growth of the next 12 months will come from? There is a lot to read here, so I'll give you a little more time. 5, 4, 3, 2, 1, and we're closing the poll. And overwhelming majority of you are saying trade disputes. Exactly 2/3 are saying that trade disputes are the major threat for global growth in the next 12 months. The second highest was other geopolitical risks. Some said Brexit and a recession in the US. Profit erosion got a little, and wage inflation and oil prices didn't get any votes. Any quick comments from the panel?
I'm always a bit disappointed that nobody picks oil prices. For me, that's such an unpredictable thing that I would always tick that box.
Yeah. Maybe if people had more than one option, they would have chosen that too.
I'm a little bit, I guess, surprised by this. I know that the trade disputes get a lot of attention in the media, and they're primarily focused on U.S. policies vis-a-vis China and more recently Europe. But I think in terms of actual economic damage that can be done by this, I think it's a little bit lower. The larger maybe disruption that could result from amplified trade disputes has more to do with business sentiment and possibly consumer sentiment to a certain extent. So personally, I would probably put that one down a little bit lower and maybe focus on Brexit a little bit more.
Yeah, I mean, interesting. The other geopolitical risks, I think, the potential escalation with Iran that could have a major impact on oil prices, among other things. That certainly something to continue watching and monitoring. So we're moving now to the US, and there things are again a bit mixed. The second quarter, which is going to be released, the second quarter GDP numbers will be released later in the month, are looking to be weaker than expected. The inventory buildup is smaller than expected, and business investment is actually probably going to be negative, definitely in equipment and structures. On the good side, we have consumption that is looking actually pretty strong, and the budget, the government budget, the federal, is continuing to provide a boost, especially in military spending, is growing very rapidly. On the negative side, as I mentioned, business confidence and investment look weak. I'll just show you in a few minutes. The conference board CEO confidence measure was again in a pretty weak territory. And manufacturing in the rest of the world and in the US is a borderline recession now, so this is also a negative development. The Fed, as a result of that and the fact that there is almost no inflation, and I would say also that there is a growing perception that the natural rate of interest rate is low. That's one of, I think, the main macroeconomic global developments in recent years, is that the long-term interest rates are just remaining very low. and something probably more structural here that is happening, and as a result, the Fed to kind of reach a neutral rate of interest rate doesn't have to raise interest rates that much. It's almost certain that there will be a rate cut in the Fed by the Fed in July, and perhaps more later in the year, although that's more data dependent. And as a result of this change in the Fed policy, moving from expectation of more rate increases to rate cuts, there was a huge drop in the long-term interest rates in the United States by more than 1 percentage point. And that is likely to boost the US economy. We're already seeing higher stock prices as a result of that. We are we're expecting to see some recovery in housing as mortgage rates drop, and the weaker dollar, which is also a result of lower interest rates, is likely to help exporters. So there will be so the weak economy is partly responsible for why the Fed is lowering interest rates, but the fact that it's planning to lower interest rate is having a positive impact on the economy. I mentioned the recovery in consumer spending. What we have here is the 3 months in the red line and the 12 months growth rate in real consumer spending. We had, you see, this large drop during the winter to almost recessionary rates. December and January were terrible months, but since then we had a strong recovery in consumption, partly because Eric understands the impact of the trade dispute on prices is not really impacting consumers.
Yeah, it hasn't really manifested itself, I don't think, in a way that a lot of people had feared. So to date, there's really been about $250 billion worth of tariffs at 25% that have been implemented by the U.S. on Chinese imports. The composition of that $250 billion has mostly been made up of business goods, intermediate inputs, things like that. There haven't been actually a lot of consumer goods that have fallen within those tariffs. However, about $300 billion worth of tariffs have been threatened against China as well. Those do represent mostly consumer goods. So in the event that those tariffs are implemented and the currently relaunched trade talks fall apart, it's possible that we could see some damage to some of this consumption in the U.S. We may even see an impact on the CPI here, which has actually been relatively stable for a pretty significant period of time. That would change the equation, of course.
Speaking about the impact of trade, there is a question here about trade dispute usually taken as a negative for. Let me take my glasses off. I'll do a better job reading. For short term growth, the question is if we think that the disputes would bring later a more robust global trading system that would increase long-term growth.
I think, I mean, with respect to the trading system, I think what we've seen over the last 2 years is a sort of a real rebuff of institutions like the WTO. The U.S. has threatened to leave the WTO. It's really sort of fallen by the wayside in a lot of ways. So I have a hard time seeing how the disputes that we're seeing right now could lead to a strengthening, a more robust trading system, at least in the medium term. In the longer term, who knows? Yeah. It's difficult to say. But certainly, what we've been seeing recently has not been good for the sort of institutionalization of global trade.
Right. Okay.
Gad, can I add something on that? On the longer term, actually, because we have published a study at the beginning of the year where we argue that we expect value chains to become more local. And this is actually a trend that already started after 2011. So we have numbers between 2011 and 2014 that show that supply chains are shortening, and a higher share of inputs is sourced locally in the manufacturing sector in advanced economies. And given all this, all the trade disputes, the increasing protectionism in all possible forms, and increasing societal unease towards globalization, we think that that is going to continue. So I would say, trade disputes or not, there is something happening, and it has been happening since 2011. And if anything, the current trade disputes are going to accelerate this trend. That's what we believe for the longer term.
Also, probably the global trade system will depend on political elections in the next several years. The main actors will be important, but we will not go there. There's also a question here about how do you explain the inventory trends in the US? So I think the very weak winter sales that we had created some unintentional inventory buildup that is now being reduced, so that's why we see much less inventory accumulation in the second quarter. I think moving forward we'll probably be in a more stable environment of kind of most companies wanting to maintain a constant sales to inventory ratio. So unless we have more surprises like we had in the winter, it will probably resume moderate accumulation of inventories. So I mentioned the strong recovery in consumer spending. In terms of business sentiment and business investment, the situation is not that good. We just released our business confidence measure in this week, and it's been weak again in the first half of 2019. We had the weakest CEO confidence measure since the beginning of this expansion, partly as a result of the trade disputes and the uncertainty as a result of that, but also the overall slowing down of the global economy is probably relates to that as well. And when you have a lower business sentiment, you also have somewhat slower investment. Those are measures of non-defense capital goods, excluding the volatile aircraft component. So we see that in August we are already in negative territory. Shipments are slowing down as well. Where we are seeing more better numbers is in investment in R&D and software, where the numbers are actually quite positive. But when it comes to equipment and structures, the numbers are pretty weak. This is a measure of global industrial production, which is dry. We see it's kind of another mini cycle, not quite negative, but very weak, below 1% year over year, which is almost as weak as we had in 2015, which was a pretty weak cycle as well in manufacturing. And that is leading to manufacturing sentiments. Here we have the new orders index from the ISM manufacturing survey. It's down to 50, which is kind of the neutral territory between growth or no growth. So not very encouraging signs for manufacturing. Of course, manufacturing is the component that is most sensitive to global conditions. So that's why we're seeing especially strong weakness in manufacturing. What we see here in the blue line is perhaps some, if you want to interpret it as good news, a very large drop in the 10-year interest rates in the US. There has been in the last, since the Friday employment report, there's been some recovery in that, but it is more than a 1 percentage point drop in interest rates, and that you see part of the strength that in the red line, which is now actually went today for the first time above 3,000, the S&P 500, and a lot of that strength in stocks is because of the low interest rates. If you're getting only 2% on a 10-year bond, then many investors are looking elsewhere, stock market as well. And that is helping the economy, also leading to low mortgage rates, which hopefully would boost the housing market, and the weaker dollar that will support exports. So the last thing I want to mention is that partly the result of the business sentiment, we are seeing some slowdown in employment growth. It's still pretty robust, but certainly weaker growth in 2019 so far versus 2018. But even with this weaker employment growth, in a period where you have essentially no growth in the working age population, this more modest employment growth will be enough to continue tightening the labor market, and we're expecting unemployment rate to keep going down. Just quickly, our overall forecast is in the second quarter, if you look at the top line, real GDP, we're expecting 1.3%. A lot of it is because of inventories, as I mentioned, but in the second half of 2019, we are likely to grow at slightly above 2%. So we're kind of growing at the trend growth of the U.S. economy. Now the 2% is the new 3%, and that's what we are expecting to see for the rest of 2019 and 2020. I think we have a couple of questions.
Just some comments between Brussels and a participant.
Okay. So Ilaria, before we turn to you, we want to hear what our audience thinks. So let's see, where will the greatest growth upside in 2020 come from in terms of regions of the world? China, US, India, Europe, Japan, emerging markets excluding China and India. So again, where will the greatest growth upside in 2020 come from? We have seen still some movement, so we'll give it a few more seconds. 5, 4, 3, 2, 1, and let's close the survey. So none of you think it will come from the US and Japan, so that is interesting. For that matter, Europe also barely gets any love here, but so it's essentially all from emerging countries, not China so much, but India quite a lot, and other emerging countries. We will talk a little more about those areas, but Eric, any immediate thoughts?
I think it is also consistent with what we are expecting to some extent, because we are also expecting India to see a rebound in growth in 2020, and now India has a stable and government which will ensure policy continuity, and it is also very clear in the latest budget proposals from India that it is going to it is trying to attract more foreign investment to India, and so on. But at the same time, India also has some substantial challenges, both in terms of fiscal prudence, and also in accelerating its manufacturing due to substantial skill challenges and so on. But despite that, I think globally India is very likely to be one of the major fast-growing countries in the world, and that is going to have a major influence on the rest of the world. But I also think that Latin American economies will also see some uptick, which will also contribute to the emerging market contribution to the global growth.
Okay.
I would just say that we should have asked this poll question before we told everybody what our expectations were. I wonder how much bias has been inserted into it.
Yeah, no, you're right. We live and learn. So, Ilaria, we are getting closer to the top of the hour, so maybe if we can get some of your main insights on Europe and the European outlook.
Sure. Let me start by thanking that one person that picked Europe on the growth upside question. And we actually, in our current first 2020 forecast, we expect growth to slightly increase by 0.1 in the euro area. Although, all in all, we are very close to the trend. We are actually at the trend. Growth is at the trend, so nothing spectacular. Now, there is some good news though, because in our consumer confidence index, we saw Europe and euro area going up. In particular, people feel quite positive about their job prospects. So that's a great piece of news, given the importance of consumption in the entire economy, private consumption. And I think that is very easy to explain, actually, because if you go to the next slide, you can see that there are some key numbers that explain this increase in consumer confidence. One is surely wage growth. It paused in the last quarter of 2018, but the Q1 numbers for 2018 saw an increase in wages again by 2.5. Now, if you think that inflation is well below 2% in most European countries, that means that there's been an actual increase in purchasing power for consumers. And if you add to that the fact that there is more jobs being created and unemployment keeps going down, that, I think, gives a good picture, gives a good idea of why consumers are feeling positive. The other thing that I wanted to talk is probably, and very briefly, the main cloud at the horizon for the euro area, and that's the situation in Germany. As you can see in the slide here, you can see that industrial production has been going down. This is I tried to smooth it a little bit. I took a 5 months average, 5 months moving average, but you can see that there's been really a rather drastic drop that started happening in the second half of 2018. And this has been particularly severe for the non-durable consumer goods, the blue line. But all of the others actually have been going down. And if you look at more recent measures, because this is up to May, so if you look at business confidence in Germany, it has been going down further, especially car makers, producers of electrical equipment. So it looks as we should take this rather serious, because this is an important part of the economy, of course. There are the trade disputes, and then the consumer confidence has been going down also in Germany, even though it's still at a very high level, but there's been a change in direction of consumer confidence. So also consumers are losing their faith in the economy in Germany. And then cherry on the cake is the fact that the government seems quite reluctant to sustain the economy, to use the fiscal leverage to push the economy further. So this is something that we're taking quite seriously, and we are started looking at this, into the details of this, as we have been doing with the UK since September, which is the last thing I'm going to say. And because I've said it many times, as I said at the beginning, we argued in September already of last year that in about 6 months we would expect the economy to go into a recession, and this is actually probably happening as we speak. From our consumer confidence index, we have one interesting piece of information, and that's the fact that a lot of people are concerned about political instability. So if you look at the actual numbers, so there is a question, and the question is, what is your top concern? And people can choose over a long list, and what most people choose everywhere, any point in time, is always health, the economy, job prospects. These are the normal top concerns. But then if you look at the UK, the share of people that picked political instability as their top concern went from 1% before the Brexit referendum to 10% now, which is as big as health, basically. So you can imagine why consumer confidence went down, and I think this is totally legitimate given the chaos around Brexit, again, now that Prime Minister May resigned and there is a leadership contest.
Yeah, so you should be all worried about the UK. We are certainly. I will, so thanks, Ilaria. We talked a lot about emerging markets so far, and I wanted a chance to focus a little on China. So I'm going to go, Eric, if you can talk a little about the China outlook.
Sure. So there has been quite a bit going on in China so far in 2019. We did see a pretty weak first quarter, although somewhat strengthening in the second, but we'll see how the rest of the year turns out. Structural factors have been really eroding at Chinese growth for a number of years. These include issues related to demographics and productivity, and also the attempt to transition the economy from more of a trade and infrastructure-driven economic system to more of a consumption and services-based economy. But that transition has really not been a smooth one. At present, China's economy is really sort of trying to stand on multiple shifting foundations. On the one hand, you have slowing global growth, which is impacting the export sector in China. That sector is not as important as it used to be, but still makes up somewhere on the order of maybe 15 to 20% of the economy in terms of value-added exports that are consumed overseas. In terms of consumption, we have positive readings both for consumer confidence, both from our in-house work in the Global Consumer Confidence Index, but even China's official NBS consumer confidence readings have been positive as well. But we're seeing a disconnect there because we're seeing people saying that they feel confident, but if you look at things like retail sales growth, for instance, it has been consistently slowing month over month over month. And so there really hasn't been that sort of that tailwind coming from the consumer. And then, of course, you have the infrastructure a part of this equation, too. Despite previous campaigns to prop up the economy earlier in the 2000s via infrastructure investment working relatively well, they really left the economy with a number of sort of issues. There was a large amount of overcapacity in a number of industrial sectors. You had a surge in non-performing assets that banks had to grapple with, and really a skyrocketing level of debt inside of China as well. So the infrastructure part of this equation, even though the government is sort of leaning towards that now, complicates things further in terms of China's longer-term growth rates. So as a result of these trends, the overall growth rate of China's economy